quickly summarize and then go through and get the new information that we need. All right. So you got the introduction. Along with the introduction, we know the important takeaway is that you want to have authority, right? And we want to know the policy reasons behind different actions. Not a bad place to start. And then chapter two, we look at the concept of gross income. Two, we know the breadth of income, very broad. Imputed income isn't. What's my authority? I'll ring B, independent life insurance company. Chapter 3, we get some other statutory exclusions, okay? That gifts and bequests, legitimate gifts and bequests are not subject to tax. What's my authority? 102A. And that's nestled in all those code provisions that give exemptions along with 101, 102, 103. In fact, last class we got introduced to another one, Code Section 109, right? Code Section 109, that if I'm a lessee and I make an improvement to lessor's property, right? They have no accretion to their wealth, right? But so they have no income, even though they feel richer, right? Code Section 109 says it's exempt. But notice Code Section 1019, peanut butter and jelly section, there's no basis adjustment, right? So those two sections, 109 and 1019, go together. All right, and then we moved on to chapter 4, employee benefits. With employee benefits, again, beyond 102, Code Section 132, a whole bunch of benefits. We know the starting point is are taxable. Fringe benefits, what's my authority? Regulation 61-21, the proposition that fringe benefits are taxable. But then Code Section 132 provides in certain instances a carve-out, right? It says that certain benefits are not subject to tax. It delineates those, and it talks about beyond just employees, includes essentially their spouse, dependent others, discrimination rules, a whole bunch of other facets aside from just delineating the taxable or tax-free nature, right? And then once we looked at fringe benefits, we also looked at meals and lodging, right? Provided for the convenience of the employer. And with the meals and lodging provided for the convenience of the employer, we have another code section, right? Wendy, what code section is that? 119, right? Code section 119. Section 119 for the proposition that meals and lodging provided for the convenience of the employer are not subject to tax. We saw that sometimes it will work, sometimes it won't. We also saw Code Section 107 extend tax-free treatment for members of the clergy. Turn our attention to computing, right? Gains and losses. And Jordan, what code section is that? 101. 101A, right? 101A, we know for gains, they must be realized and recognized. For losses, they must be realized, recognized, and allowed, right? And the word allowed, KB, do you remember what code section that is? 165, right? They must be realized, recognized, and allowed. All right, so we got that, and we saw that there's a whole bunch of code sections that deal, right, with our very simple formula, right? Amount realized less adjusted basis equals gains and losses. Agreed? Amount realized less adjusted basis equals gains and losses. So if you buy a property, Jack, what's your basis in the property?
The amount of money or the fair market value of property exchange, the property received.
The basis if you purchase something is what?
Oh, the amount of money spent.
Right. And that's what? What's in the tax jargon? Your cost basis, right, Jack?
Oh, yeah.
Yeah. Okay. And what code section?
10, 12.
10, 12. And Eugene, if I give you a gift, what's your basis in the property? Oh, yeah. Is that right? Always?
No.
You want to retract your answer? Should she retract or keep her answer?
I'm sorry, what was the question again?
What's her basis?
Oh,
The exception is if it's within a year of death.
No, but no one died. It's a gift. Above ground.
Oh.
isn't it a transfer basis?
Is it right? Jack, you got to walk the walk and talk the talk, right?
Right.
At the water cooler, right? Well, it's a foreign language and you're learning it, right? Carryover basis, right? Eugene, Natalia, you will see this in 2 weeks on your exam, even sooner. Are you going to get mad at me or yourself if you get it wrong? I know, you'll be mad at me, but take some ownership, guys. It's not my one job here. I only have one job. Teach you guys tax and teach it well. But you got to help me, okay? You got to help me. Jordan.
Carryover under 1015?
Carryover is over 10, under 1015. Kyle, is it always carryover?
No.
When is it not?
If you're receiving it as a request.
No one's dead yet.
Oh, okay.
Is there any exception to the carryover basis rule? Chevron. I can't. Got it right the second time. Here I am telling Jack he's got to talk the talk and walk the walk, and I can't even say your name.
Between spouses.
Chevron.
Between spouses.
No.
Gifts to employees?
That's 102C. I'm talking about, is your basis always a carryover basis?
No, not if you sell the gift.
Tell me, if I sell the gift, what?
Then it's going to be the fair market value.
Always?
Not always. If you sell it to your spouse, then
No.
Is it the regulation?
No, it's not the regulation. Come on, guys. Again? Guys, 1015A, didn't we talk about an exception to the general rule?
That if the basis is greater than the fair market value of the property at the time of the gift.
Yeah, that's it. That's when Eugene gets mad at me because I ask her the question and she doesn't get it right. And hopefully you'll get it right, right? Eugene, you're going to prove me if you get property, this isn't working, dollar adjusted basis, $25 fair market value, right? Right. So if you bought that property, it's a loser, right? You bought it for 100, it's only worth 25. You agree? And I give it to you as a gift. And you sell it for $20. Gain or loss, Eugene? Eugene, I gave this property to you. You now sell it for $20. Loss. Of how much? Natalia.
You sold
Just say it loudly.
Loss, but you sold it for 20 or 25?
Sell it for 20.
Oh, then loss of 80. I agree.
Eugene, you disagree with yourself.
Very close.
What's the answer? Natalia, this is where you take a basis in this exception under 1015A. Your basis becomes 25. It's not a carryover basis for purposes of determining a loss. This is 25. If you sell for 20, oh yeah, but don't do that on the exam. You're not going to be happy with yourself. I'm not going to be happy because I'm going to be like, why was I up here Mondays and Wednesdays? They're not listening to me. for 120 in that case, Wendy? Gain or loss of how much? Gain of 20, do you agree, Galena?
Yes.
Yes, right? So if you sell it for gain, you're in the usual role, right? Carryover basis. Right, Shervon?
Yes, correct.
Right, Shervon, if you sell for 50, what happens? Computer superstars here. I'm just pointing out to you, if you go to WebEx, you sell for 50. Shervon,
No gain or loss.
what's your authority?
10, 15, 8.
What? 10, 15, 8 doesn't really say that. You have better authority, James. Say again?
1015 D1A.
1015 D1A. D1A deals with gifts and gift tax paid. It has nothing to do with computing gains and losses. It talks about basis.
1015 D6 special rule.
No, but that's for gift. There's no gift tax paid in my example. I'm just asking you, if you sell it for 50, Shervon, you said there's no gain or loss. You have compelling authority. I said it to you in class. Next to your notes, you have this next to one of your problems.
Is it 1015-1 2?
-1A2, right?
A2, yeah, right.
Regulation 1015-1A2. You remember the example? That was right
Yeah.
on point. Natalia, you remember that example? No? Were you here? I think you were here on Monday, right? Well, your notes. We went through that example, 1015-1A2. Everyone have that? Everyone should have circled it. Natalia, do you want to open up, Natalia, can you open up to your regs, regulation 1015-1A2? For those who have the 2019, what page is it on? Hey, Natalia, want to circle that in bright red.
So how do we solve this problem of no gain and no loss? Because
It's not a problem,
right?
it's a good thing.
Because no, I'm saying in the shoe of IRS, you know, since there's no gain and loss, you can't really tax them, right?
The job of the IRS is not to tax people, it's to have people comply with whatever Congress demands the law is.
Okay, sorry.
I mean, just remember that. The role of the IRS is not necessarily to generate revenue, it's to collect revenue from people.
Second part of my question is, it doesn't matter because the adjust basis has been replaced by someone who who purchased the property, right? So
Okay, repeat.
so you know,
Well, I'm talking about a gift. There's no one making a purchase, so I'm not sure what your question is.
if that, but so what's
No
the
one making a purchase.
yeah, but so what is the adjusted base after this?
For what purpose? You mean if I give you a gift to this property?
Yeah, in this example.
In my example that I just gave you?
Yeah. So
Well, you tell me. Okay, everyone here, I give this property to Jiang, and his basis starts off at 100 or 25. You don't know what your basis is.
yeah,
right?
that's what I'm saying.
Okay, but the answer will depend if you sell it for gain or loss, and then we'll know what your basis is.
On the
So
sale,
until
right?
on the sale,
On the sale, before the sale.
we don't know anything, right?
Well, you do know something. Your basis will either be 100 or it'll be 25.
Just a quick question. 100 is the basis of the gifter, right?
Yes.
That's where we get the 100, and then the
Absolutely.
25 is the fair market value.
That's what I bought it for.
If it's under, you have a loss. If it's over 100, you have a gain.
Careful, you. Who is the you?
If the
I give it to you.
If the giftee then sells it for $20,000,
Yes.
under 25, it's a loss. They sell over 100. If the giftee sells it for over 100, gain.
Right.
In between.
A gift, you have bequests under 1014, right? Basis equal to fair market value rule, except, one of you guys made a reference, there's an exception, 1014E, right? Gifts within 1 year of death, the recipient doesn't get a basis equal to fair market value. We have code section 1041. Not all realized gains are recognized. Not all realized gains are recognized. And then we moved on and talked about the amount realized. We talked about the famous Crane case, right? And if you haven't read it, it's required reading because we know the amount realized has 3 ingredients, right, Jiang?
Yeah.
Can you tell us the 3 ingredients for the special sauce?
Cost.
What do you mean by cost?
Sorry.
The fair market value
Yeah,
of
fair
other
market
assets, right? So we saw that debt is one that often people overlook for exam purposes. Everyone listening to me? No one's going to say, there's a lot of information. We couldn't really absorb it on Wednesday because it's too much. It's important. You guys have to absorb it. And I'll be a little biased here. What's your most important class this semester? All right.
Income tax.
All right, that's what I want to hear. Right, JP? Most important class, you're right here. This is triage. You got to make sure you know what is and what isn't important. Needless to say, I'm a little biased. Tax is your most important class. And you can look me in the eye and say so. And if you don't think so, that's okay. All right. 23, we moved on, right? Any questions? Because that's for
21.
excuse me, 21. I apologize. Getting a little bit too enthusiastic for my own. Capital gains and losses, and I gave you a very short overview, but we're going to blow through this stuff today, okay? Capital gains and losses, let's just make sure we all know. Maximum capital gains rates generally is what? Maximum capital gain rate?
20%.
20%. Okay, 28% does apply to collectibles. There's 3 different rates. The most utilized one is 20%. In the case of collectibles, it's 28%. And we'll learn more. Something called unrecaptured 1250 gain is taxable at 25%. Ordinary income tax at what rate, guys? Maximum rate is 37. What's your authority? Where do you see those rates?
So, I think code section 1.
All right, code section 1. Let's just keep it there for now. Now, by a show of hands, and if you don't mind me saying this, don't fence it, okay? Don't say, well, I don't know. Either thumbs up or down. So let me give you the question, then I want to see. How many of you think that capital gains should get a rate preference akin to what we have in the code? And how many of you don't? So in other words, everyone, if you think capital gains should get a rate preference, in other words, capital gains are generally taxed approximately 1/2 of what ordinary income. If you think that's a good idea, and then my next question will be, how many think it's a bad idea?
It's bad in the sense it should get taxed more or
It should be
less?
taxed at the same rates. The capital gains and ordinary. So let's start with the first question. Who thinks capital gains should get a rate preference? Say no rate preference, because there seems to be very. Anyone think that capital gains and ordinary income should be taxed at the same rate? So everyone here looks like. Can I just put words? Everyone thinks it should be taxed at different rates, right?
Actually, I think it should be taxed at the same rate because it'll make my job easier.
Well, that may not be good, because if your job's too easy, then you'll be paid less.
You'll also
Oh.
But let me ask you a question, because there's some people in this room, apparently, and James's hand shot up, who has somewhat of a religious fervor about this.
Absolutely, less taxes. always.
Yeah.
But
Agreed.
having said that, let me ask you why. I mean, less taxes, you could say, well, let's have less taxes on ordinary income, which you'll say, of course, too. But that's a different issue, James, because the question is, it can come from different places. So you could say, well, we should reduce the ordinary income tax rate, and we can do that by raising the capital gains rate so that they meet in the middle. So just saying less tax and lower tax rates doesn't get you into a good policy objective. So the question I have is, should capital gains be taxed at a lower rate than ordinary income? And is your answer still yes? And if so, why? Where is it just, many of us subscribe to religious beliefs and we can't explain it. We just say we believe.
Leading that.
It's not a good way to formulate tax policy.
Incentivizes people to invest in businesses.
Okay, so let's just go through your thought process. So Justin, you say it's good because why?
Because it incentivizes people to invest in other assets.
What does that mean?
Like,
If there weren't a capital gains rate preference, what would they do with their money? Remember, they have different returns even absent tax, right? Everyone agree? And absent tax, that because it's riskier and you guys associate risk with greater returns, possible greater downside as well, but those who have a certain risk tolerance will still invest in stocks. And those who don't will probably keep their portfolio, this is conjecture on my part, pretty much the same. I don't think you're going to see a great outflow of monies from the stock market if the rates were the same. That's my conjecture. I have some evidence to prove me somewhat right, because when capital gains and ordinary income, were they ever taxed at the same rate, guys? Ever? 1913 to 1921 they were. Okay, it's capital gains rates were introduced in 1921. Ronald Reagan and the then Democratic Congress in the 1986 Tax Act, guess what? Capital gains and ordinary income were taxed at the same rate. Okay? They raised capital gains rates and lowered ordinary income tax rates, and they were taxed at the same rate. Did the sky fall from 1986 to 1991?
Still here, so I guess
We're
not.
still here. And the stock market, did it collapse? No, it actually did pretty well. Is that
I have a counter argument on that point though, because at the time, while Volcker was the head of the Fed,
right?
the interest rate was very high. So you should. That's what I think. What I'm saying is, interest rate was around 8 to 13%.
It was crazy.
So even if I put my money in the bank, I'll get enough returns. But like think about right now, the interest rate is very low, and like.
So what is your point? What's your takeaway?
What I'm saying is, at the time there was not a huge incentive to invest on, like risky stocks and stuff like that compared to.
It is that people did not sway in 1986 when the rates were changed into one united rate. People did not run to put their money in the bank, even though, in your words, they could have gotten the same return, right?
Oh, I didn't say same, but I mean.
A comparable return.
Yeah.
But that didn't happen. People will argue, and apparently many of you in this class subscribe to the religion of capital gains rates being lower. And they do it for the basis that it's going to incentivize people, like Justin said, or maybe make entrepreneurs, make it attractive to form companies. But again, Bill Gates, who started his enterprise where? In a garage? You think he was dwelling on tax rates when he was working on developing Microsoft, guys? Just in his DNA that he wanted to develop this product. I don't think he thought one bit about tax rates. And whatever they were, would have said, let the chips fall where they may. I got this creative energy. I'm going to develop this company. That's my instincts, rightfully or wrongfully. Now, you might say, okay, part of the reason for capital gains rates is that people who hold, for example, stock for several years, they have what's called income bunching, right? Because they hold the stock, it goes from $10, say, to $100. Then $90 of gain is all taxed in the same year. Everyone agree? They hold the stock for 5 years, and that might bring them up the marginal tax rate, right? Because if you look at Code Section 1, there's a graduated rate. Everyone agree? So if you have all this income being taxed in 1 year as opposed to a mark-to-market where it's being taxed annually in the growth, and you're forcing all that growth into all that income into 1 year. Okay, fair enough. But people who work in the service industry, for example, you take an antitrust lawyer who works several years on a case, okay, and is successful, he or she, and collect all their income in year 6 that they've worked for over a 6-year period. They have that same bunching that the person who owned the stock did. So all I'm saying, were I king for the day, you may not agree to this, but to Kyle's point, is that I'm a believer in trying to keep the code as simple as possible. You will notice as you go through this course, and if you take other tax courses, probably 20-25% of the code's complexity is tied up into this rate difference between capital gains and ordinary income. Really, from a policy grounds, is it justified? And I would argue not. I think the code, Kyle, again, to your point, could be a hell of a lot simpler. And I'm not sure if the justifications weren't. And James, to your point, if you want lower tax rate, listen, that's a different issue. I'm not getting into the politics, good or bad, but you could still say, look, I want lower tax rates. Let's lower the individual rate. And if you want to keep the revenue neutral, raise the capital gains rates. But until someone can really show me, and as you go through the case book, a really meaningful justification for the rate difference, I'm not entirely, apt to sign on myself. But there's people, obviously, who feel a whole lot different than I do. But on an exam, I'm not going to test you on your, what do you feel about this? And you guys will answer because you've heard me. You'll probably, I know how that works. But I wouldn't ask that kind of question. I just want you to think about these things as opposed to just blindly turning the pages. Because your whole career, you're going to be faced with these issues. I think your workday is going to be a lot more interesting. You don't just, you think about some of these things. They're fascinating as a society, what choices we make. James, you were going to comment?
I wasn't. I just agree.
All right. So anyway, you guys can read about capital gains, the rate preference, capital losses. Congress has to put limitations on capital losses. Why? Because otherwise, people could strategically time their capital losses to take in 1 year when they have ordinary income and use it to offset income tax, 37%, and the next year take their capital gains and command a rate preference at 20%. So you will notice that there is a Code Section 1211, which essentially Code Section 1211 requires a matching, that you can only take capital losses up to capital gains. There is a $3,000, for the case of non-corporate taxpayers, there is a $3,000 grace. Congress built in a $3,000 grace for capital losses for small-time investors. But corporate taxpayers can only take their capital losses against capital gains, and to the extent they can't use their capital losses, they can carry them back 3 years or carry them forward 5 years. What's my authority? Code Section 1212. Section 1212. So again, page 687 articulates the rationale for capital loss limitations. Everyone understand why capital losses must be limited? If you don't understand, do yourself a favor. Okay? Look at the example on page 687. If you see that indented language, okay? That indented language gives a very nice example of why Congress had to institute the capital loss limitation rules. 688. The authors go through a somewhat lengthy discussion of the netting process. Now, for exam purposes, guys, this is good news. Everyone listening, because everyone likes to hear good news, right? You'll tune me out for bad news, but good news you want to listen to. All right? Purposes, I am not going to ask a single computation question. What I mean is, you're not going to see on the exam, compute the taxpayer's tax due, okay? Why? Because what do people in practice do? You know and I know. They put in the numbers and the computer spits out, right, the tax computation. And I don't need you guys to become, proficient in HR block. No offense to, and I'm not saying this pejoratively, the folks there, they too are not taking out a calculator and computing the tax, right? Their software programs are going to do it. I'm not going to ask you to do it. So notwithstanding some of the problems here, ask you to figure out the tax due. You're not going to see anything like that on the exam. Everyone okay with that? Anyone complaining? Anyone want me to?
What about amount realized and amount paid?
That everyone here can handle, and that a computer will not tell you, right?
That we have to know.
That you definitely have to know. You have to compute the amount of gain. And if I put in a simple problem like assume the tax rate's 40%, okay, you can multiply 40% and tell me the tax due. But I'm not going to ask you, okay, after you take into account the standard deduction and the progressive rate structure, that's not going to serve anyone's purpose, okay? So I'm I'm just letting you know, because some of you may read the material beginning on page 688, and sweat may form on your brows because you're like, oh my God, this is going to bring a whole new dimension. And I don't want to have it. I want you to be just like myself when I practice. You got to be a little bit, have that adrenaline going through you, because if you don't, tax is not meant. I said, for a wine glass, tax is meant to be practiced with 2 espressos on your side. Okay, you've got to be juiced up, because if you don't, things can fall through the cracks. And when things do, it is not a good day at the office. And we want to minimize the bad days in the office, right, guys? So the authors, right, talk about different rates applicable, and I just want to emphasize, corporate taxpayers only pay one rate, okay? They pay the rate expressed, and you'll see this when you take corporate tax after you're done with me. Code Section 11 has the corporate tax rate, okay? And currently, because of the new Tax Act, it's a flat 21%. A flat 21%. Corporations do not get a rate preference, okay, for capital gains. There is no rate preference for corporations for capital gains. Okay, so just keep in mind when we're talking about the rate structure, right, as Jiang pointed out under Code Section 1 of the code, it's only for non-corporate taxpayers, okay? There is no rate preference for corporations. They're already paying a much lower rate. And the authors, again, beginning on page 691, talk about the different rates. And for their purposes, the author's purposes, beginning on page 693, they go through the computations. Again, you're not going to have to worry about doing computations. We're going to keep it real simple. They go through on 694 computations. They do, I'll just point out to you on page 694, if you look at associated with footnote 37, it's well hidden within Code Section 1H are a variety of netting rules that are happily reach a pro-taxpayer result. This is, and then they direct you to footnote 37, okay? And they point out that when they say pro-taxpayer, it says under Code Section 1H, the netting process, netting first occurs at each rate classification. There are net losses within any classification. They then wipe out the net gains that otherwise would be taxed at the highest rate for a combination of rates under Code Section 1H1 schedule. So I just point out to you that, and you'll see this in these simple examples. I don't want to, how do I say, I don't want to overindulge in the examples because you're not going to be directly tested on this material, aside from just knowing that there is a rate preference for capital gains. On page 695, let me take the lead here, and let's just talk about the rate preferences here and how they would apply. So on page 695, it says T, a single taxpayer, has a salary of $200,000 in the current year. T also has the following transaction, all involving the sale of capital assets: a $15,000 gain on collectibles held for 2 years, and a gain of $20,000 in stock held for 15 months. So $200,000 single tax, I think he's single, right?
Yes.
Example, yeah. So he's going to be, for Code Section 1 purposes, on the high end of the tax rates, okay? And you'll see in a moment what I mean by that. So he had a sale or exchange, right, under Code Section 1001, right? Because that's how he was able to compute the $15,000 and $20,000 gains. And question A simply says, determine T's net capital gain. Well, his net capital gain is just the addition of 20 plus 15 or 35,000. Okay, nothing complicated there. So he has a net capital gain of 35,000. And it says, at what rate will the components of T net capital gains be taxed? So, guys, again, this is the only thing I would ask you is his capital gains, for my purposes, the collectibles is taxable at what rate? 28, and the stock? 20. Done. Game over. And question C, I'm not going to worry about it, nor should you. You're not going to see anything like it. Okay?
Professor, what's an example of a collectible?
Collectibles, coins, art, those are collectibles. Even the authors point out liquor. I'm not sure who collects liquor, but KB, do you know people who collect liquor?
I do.
Japanese whiskey.
Oh, you said coin.
Can be
wine.
seen as a collectible.
It's true. Do Japanese have special kind of whiskey? I never
Yeah,
thought.
they apparently right now the most expensive whiskey is in Japan.
Okay.
Actually, last year, I mean.
I have to say, I was in Tokyo last
was shocked.
December. Anyone been to Tokyo? Anyone? Sure, Vaughn. What were some of your impressions of, I don't know when you were last in Japan?
About 2 years ago.
And any lasting impressions about Japan?
Oh, they're very technological advanced.
I'm going to say this. I've never seen such clean public bathrooms in my life. Okay? Many of them had built-in bidets. I mean, in a public bathroom. So it was like, this is incredible. And then on top of that, I'm convinced that 90% of Japan is underground. Because when you walk around, you say, oh, there's a store or two. And then you go into the subway, and it's like 10 levels down, and everywhere you go, there's stores, and they just seem endless. I have to say, it was quite an adventure. So, thinking of last December, who's Shawn Mendes? What song? What's the song about Lost in Japan? Or come on, you're supposed to know this better than I know this. No? Come on,
Come on, Jack.
I'm gonna have to do a Google search. What's the name of that song? All right, I can't think of it. I was gonna Google it for me, James, so I don't embarrass myself too much. It may not be Shawn Mendes. I don't know. It is. What's the name of the song, Kalina? Wrong country.
In Japan,
Yeah, I think it's Lost in Japan. Is that the name?
if I can't have you.
You just double click and I hear it.
Got it coming now.
Coming up?
Oh, this one was Zed. This is probably a good one.
If you have it, I mean, I think everyone here has probably heard it. If I've heard it.
Oh, hold on. This is a long ad.
Yeah, you can't skip it.
7 seconds.
Now, waiting
So
for these
what is your
ads.
purpose of going to Japan?
I had my kids insisted that if I go, they needed Wi-Fi and they needed it just quick. So what better place in the world for quick Wi-Fi, right? Everyone knows this song, right? You never heard this song? You never heard this, James? You've heard it, right, Gian? I got to get you guys out more.
We need to come to home reading this.
We need, right? You know what this calls for, James? October 26th,
Plugging it.
tax event, right? All right. All right. When you get a chance, your homework in addition for next, the name of the song again is Shawn Mendes. What is it? Lost in Japan, right?
Yeah. Shawn Mendes lost.
Mechanics of capital losses, page 696, okay? You may, why not? Not may, let's open up code section 1211. In the case of corporation, losses from the sale or exchange of capital assets shall be allowed only to the extent of gains. Essentially, you can't take losses in excess of gains. By way of contrast, all other taxpayers can take up to 3,000 of their capital losses. To the excess, keep reading. Code section 1212. The excess with corporations, they can carry back 3 years and then carry back or carry forward up to 5 years. In the case of other taxpayers, this is 1212B. they have to carry it forward. Okay? Have to carry it forward. My individuals, you keep having capital losses. What happens when you die with your capital losses? They disappear. Add that to your list of things you can't take with you. Okay? That's on the list. Monetary goods, all the other things, well, add capital losses. See Code Section 1211, big limitation on capital losses. Then Code Section 1212B, there's a carryover. And on page 698, 699, what you're going to see, and we're going to see this in the problems, is that there's a real bias in the code using the short-term capital losses first, and then using the long-term. So if you have a combination of short-term losses and long-term losses, and you can only use one, what we're going to see is there's a bias towards using the short-term, okay? We'll see this come up in problems, and if you read the material, I hope you have, on page 699, it explains how to get there. $701. Here are two questions on capital losses incurred in the current year. The figure for taxable income given in column A reflects a single taxpayer's income for each of 2 years without regard to his capital gains and losses. Note that in computing gross income as adjusted on the tax return, no gains will be included since capital losses exceed capital gains, and the 1211B excess amount will be a reduction. Right? Problem one, the person has both capital gains, capital losses, short-term capital gain, short-term capital losses. So net one, you get to net your capital gains, long-term and short-term. Code section 1222. Code section 1222 tells you to net your short-term and long-term capital gains first. And when you net, what do you have? Long-term capital loss, right, of 4,000. Everyone agree? The math there is not hard. You have short-term capital gain of how much? 1,600, right? I apologize. I got too excited. On page 696, let me just go back for one moment there. I left you off. I left you hanging. Back to page 696. Column 2 says single taxpayer with a salary of $500,000 as the following transaction involving the sale of capital assets, $120,000 on stock held for 15 months. Or why is it 15 months? Could be anything. But to get long-term capital gain treatment, how long do you have to hold it, a capital asset?
1 year.
Finger. It's got to be more than a finger. Right? More than. Okay? 1 year will not cut it. More than 1 year. Okay? So that's why the authors say 15 months. And a loss of $20,000 on the stock held for 3 years. Assume there's a flat 30% ordinary income tax rate and ignoring any deductions. What's his as his tax liability in the current year? And the author's only point here is, or my takeaway is, you would net, right? So the takeaway here is a long-term capital gain, and because this is a high earner, it would be subject to a 20% rate, right? That $100,000 in net long-term capital gain would have a 20% tax rate. Okay? Question 3. Who's in the highest federal tax bracket in the current year has a $5,000 gain from a collectible and $5,000 gain from stock. Okay? Both held long-term. His net capital gain, and how is it taxed if he also has a $5,000 loss from a collectible held long-term? Okay, if it's collectible, then you would do what? You would net the collectible against the collectible, leaving $5,000 of capital gain, right? That's taxable at 20%, right? What you're supposed to do is net against the same classes. Same classes, okay? What results in A if taxpayers 5,000 losses from long-term capital stock? From stock. Well, if you net the long-term against the long-term, that will leave you 5,000 of the gain from Scotch or Japanese whiskey, right, KB? And that being the case, it will be 5,000 taxable at 28%, right? A loss, short-term loss, okay? The short-term loss is not going to necessarily be, you can use that, and I can give you some code authority for this. But again, I wouldn't go into such detail for an exam, but code section 1H5, capital letter A, I. I'll repeat. Code section 1H5, capital letter A, one little I. Use that short-term loss against the collectible. So what ends up happening is you have a $5,000 capital gain taxable at 20%. So it's a little counterintuitive, question 3C, but you have the authority of code section 1H5, capital letter A, one little I, so that you can use that $5,000 loss against the collectible gain. Question D. Taxpayer's net capital gain, and how is it taxed if taxpayer has a $5,000 gain from a collectible, $5,000, so that collectible is taxable at 28%, 5,000 unrecaptured 1250 gain taxable at 25%, and a $5,000 gain from stock taxable at 20%. So I apologize. The unrecaptured 1250 gain is taxable at 25%. $5,000 gain from the stock is taxable at 20%, and you have $10,000 loss from stock. Well, where does the first $5,000 of the long-term capital loss get netted against? The capital gain from the stock, right? Same class. Everyone agree? Same class. And then this is in accordance with the position of the Treasury regulations. If you, as pointed out, in footnote 37 on page 694, the remaining 5,000 you can use in any way which is tax favorable. What's more tax favorable? Using this against the collectible or using it against the unrecaptured 1250 gain? And it's more favorable to use it against the collectible, which is taxable at a higher rate. So for your notes, what remains is $5,000 taxable at 25%. It would be the unrecaptured 1250 gain. So when you go through the netting process, that's what would remain.
Net losses.
Once it exceeds that class, that category, you can net it against whatever you want.
Okay.
So like this in a tax-friendly fashion.
Of course.
Back to page 701. 701. We're back to problem 1, where we have long-term capital loss of 4,000, short-term gain of 1,600, right? What's our, now we can net these two, right? We can net these two. And what's the upshot? Whole capital loss against ordinary income because it's less than 3,000. Everyone agree? 10,000, again, total income. We have long-term capital gain, long-term capital loss, right? What's our long-term capital loss then? An issue here, right? Because our total losses are how much? 10,000. Everyone agree?
Yep.
What can we use? 3. On one hand, this is easy, right? Because we're going to be able to use 3,000, right? And how much are we going to have to carry forward? 7. So here's the issue. 7. Under code section 1211 is the limitation. 1212 tells us to carry forward. For the short term or the long term?
Short term, right?
Well, the bias is to utilize the short term. So the code actually says, it says Your computer program will do this for you. But what it does is, and the authors point this out, under Code Section 1212B, it creates a fictitious gain of 3,000. That eliminates short-term loss, creating I put parentheses here, but it creates a positive 3,000 short-term capital gain, creating a 1,000 short-term capital gain, which would be netted against the long-term. What does this yield? A 7,000 carry forward, long-term capital loss carry forward. So let me explain what's going on here. The code artificially, just for purposes of computing the carry forward, artificially creates a short-term capital gain. What does that do? It essentially says, for purposes going forward, we're going to use in the current year, if this happened in 2019, we're going to use the short-term capital loss this year of 2,000 plus 1,000 of the long-term capital loss, right? Totaling what? 3,000. We're going to carry forward the 7,000 of long-term capital loss. This one, James, you may not be a fan of because by carrying forward the capital loss, the long-term, not the short-term, going forward, which kind of capital gains get a rate preference? Only long-term capital gains, right? So by forcing the taxpayer to carry forward the long-term, in later years, the taxpayer is not going to be able to exploit as well as he or she could the benefits of the preferential tax rate, right? So if there is an agenda here, Congress, again, created this bias towards utilizing the short term currently and the long term in later years. Okay? Think about that. Try to absorb it. If you don't get it, Wendy, reread it. Just reread that page or two, and it should be pretty evident. Okay? Now, we've been talking for the last hour or so, and towards the end of last class, about capital losses. But one question we've left in abeyance, definitional question, is what is a capital asset, right? What is a capital asset? Agreed? Turn to find that answer as we turn to find all answers, Kyle.
Code section
The code. What section?
1221.
1221 is probably a good place to start because it's entitled what?
Capital asset decline.
Probably a good place to start because it's called capital assets, right? And by reading this definition, in general, is it a broad or narrow definition? Are capital assets broadly or narrowly defined in the code? Very broad, right? Doesn't it say essentially all assets in the world are capital except as otherwise provided? So it's the antithesis of what some of you might have expected, right? Because capital gains do command a rate preference. Congress would define it narrowly, but it actually at least starts off very broadly. Agreed? Fine. What are the exceptions? Items are not considered capital assets. What can anyone name 2 or 3? I'll call them things that jump. James, you have one?
Yeah, property used in business.
2 of them.
Illicit business.
Receivables are not capital assets, right? Receivables are generally not capital assets. And we're going to learn that assets used in a trader business, like a cash register, or if you're a landscaper or a lawnmower, and if you want to sound cool, Jack, at the water cooler, I don't blame you. I do too. I never measure up, but if I did, I would. What would you refer to those assets as? You're in your winter internship, and someone's talking about assets used in a trader business. You want to sound cool. Finally, because you're thinking Jonas Brothers, the song Cool, they were thinking about this, right? I know, Justin, you're thinking, where's my brain? That's okay. Just trying to keep you guys going on a Wednesday afternoon, okay? You have it, Galena. You're going to sound cool at the water cooler. 1231 assets, okay? We're going to learn. But section 1231 assets are not capital assets, but guess what? They're better than capital assets. I know that's hard to believe, but 1231 assets are better than capital assets. Not capital assets. Okay, everyone hear that me? People get that wrong on the exam. And people listening on WebEx, okay? Listening to me on WebEx? Guys listening? Supposed to type in yes. Okay, good to hear that you guys are awake. Okay, folks on WebEx, remember, 1231 assets are categorically not capital assets, even though they may command capital gain treatment. So inevitably, people will respond, I don't know, they're not listening, but you guys, even on WebEx, you're paying close attention, right? That's your another cue. I need another yes with an exclamation point. Yes with an exclamation point. These are not capital assets. Where's my yes with an exclamation point, guys? All right. If you don't, I will. Are 1231 assets? Assets, then the answer is no. Okay? Type yes with an exclamation. I can type no with an exclamation. So, what other big? Okay. I'm still missing the exclamation point. I want some emphasis here. What, guys, is the biggie that you missed that is not a capital asset? Kyle, the biggest one, Shervon. What is the big asset, category of asset that is not a capital asset?
Stock.
We think of as the traditional capital asset, right?
Property.
We know it's not a capital asset, it's a 1231 assets. Justin, Jordan, Galena, Wendy. Oh, come on, guys, you're missing the obvious. When you go to Home Depot, what do you pick out of the aisle?
Oh, inventory.
Inventory. What's that? All right, so inventory is not a capital asset, right? Inventory is not a capital asset. 3 categories, right? Big ones. I mean, there's others, right? When you look at Code Section 1221, 21A1, essentially that translates into inventory. 21A2 is 1231 property, but there's others. 1221 A3, patent, invention, model, design. Those are all not those criteria. They're not going to be considered capital assets. Accounts receivable, that's 1221A4. There's some other, but the big 3 are receivables, 1231, and inventory. Probably inventory is the biggest non-capital asset, okay?
1231 are just assets used for greater business.
Yes. But, so does everyone here think they have a good command of what is a capital asset? You guys think you have a good command? Anyone not think they have a good command? Like making dinner conversation tonight, you can say, you know, this fork I'm holding, you can look around the table, whoever you're sharing your meal with, and you can ask them to identify, is it a capital asset or not? And they probably won't say it's capital, but is it a capital asset, your fork? Yes or no?
A restaurant, it's not.
No, you're at home eating dinner.
Yes.
Yes, everyone agree? Natalia, no? It's a capital asset at home, right? Plate. What kind of asset is that, Natalia? A capital asset, okay? Okay? You taking a shower tomorrow morning? What's your bar of soap, Jiyoung? Capital, right? Everyone agree? Getting the swing of this, okay? All right. So do you want a story? 10 years ago, I'm reading the front page of the New York Times, and there's an article there about St. Barnabas Hospital. You guys know where St. Barnabas Hospital is? If you don't know, first of all, it's in Livingston. But if you ever get, unfortunately, severely burned in a car accident, that's where you're going. You're going to be heliported to Livingston. It probably has the biggest burn center in the state, okay? If you don't know it now, hopefully you'll never know it for that reason, but it's a pretty big hospital. Everyone agree? Those who know it, about 20 minutes from here. I'm reading it's a front page story, and what's going on? I'm reading the article because they are paying, the hospital is paying women $5,000 for their eggs. Okay? I'm reading along, and you know what question comes up in my mind?
Amen.
No, that's not my question. Not my question. My question is, how are they treating that $5,000 for tax purposes, right? Income, 61, right? We know it's income, right? That's the easy question. So the question is, how should these women be reporting it? Now, I happen to know the director of the infertility clinic at St. Barnabas. So I called up Paul, and I said, Paul, this is a fascinating article. Congrats, it's in the Times, but I want to know, how are you reporting this to the women? So what does Paul tell me? Now, does it look good for a hospital to look like they're buying and selling babies? Doesn't look good, right? Eggs. Is that easy or hard? The men might not know, the women will. Do you think giving eggs is easy or hard?
Painful and hard.
Maybe?
Painful and hard.
Why?
Because of how they extract the egg.
Right. It's not easy, right? You got to get, I'll call it fertilized with Clomid, okay, to try to get a lot of eggs, okay? And it's not a simple process. So what St. Barnabas was doing was reporting it as service income, miscellaneous 1099 income, right, for services, because it's not an easy process.
Because of the time these women take.
Yeah, these women are, to take the fertility drugs and then to make sure that it's the right time to harvest, and is not having eggs harvested, but I understand that it's not easy, right? Everyone agree? Not easy, and so you can see that, right? Question becomes, literally 6 weeks later, there was another article that someone was willing to pay for a tall Ivy League graduate $50,000 for her eggs. So someone was upping the ante by putting an ad in the Cornell, I don't know, the undergraduate, and upping the ante and saying, hey, pay you $50,000 for your eggs. They're really
sheep it.
Well, that's the question. How should that have been reported? At some point, don't you agree, Justin, it's truly not for services? I mean, you could say for $5,000, hey, but at some point, if someone said $100,000, at some point, you're going to say it's truly for the eggs, right? The question is, what is the proper reporting on that gain? Your argument would be, Wendy, how might you report it? You're not answering my question. How would you report it? Lena, have any ideas? Brendan? Have an opinion of those people on WebEx, how you might report it? Anyone on WebEx going to report? John?
I think we should report long-term capital asset.
Long-term capital gain?
Yeah.
And why?
I don't know, but because these eggs are created when you're
More than 1 year.
Aren't women born with their eggs?
Yeah. As I check the arc. So James, what are you going to report and why?
Well, to me, the way I see it, the eggs are finite and the women have it after a certain age, so she more than a year.
Yeah.
The item she has that's not associated with the business though, so it's not 1231.
Okay.
So to me, I would report it as a long-term capital gain and tax at 15%.
So you would report it as,
Well, why do we do 15% slash 20%?
plus if you're a lower income taxpayer, it's actually 0, 15, or 20, depending on how much money you make.
Right, so she's in college, so I think she should pay 15.
Well, if she got paid 100, she might thwart her or thrust her into a higher bracket.
All right, so then 20%.
Someone's responding.
Oh, long-term capital gain. That's Shia? Hi, Shia. I didn't recognize your name, but okay. Thank you, Shia. So we're going to say long-term capital gain, but okay. So we'll continue my story. So I actually wrote a paper on this, and it actually ended up on the front page of the Wall Street Journal of what tax professors are debating.
Good for you. That's impressive.
Well, here's where the here's where the story goes with this stuff. Okay, here's the story where it goes. Is that subsequently I was talking to friends and they said, "Oh, what are you doing?" I said, "Oh, I'm working on this paper." And this woman said, "Oh, I sold my eggs." She was going to Harvard, and she sold her eggs. And I'm like, "Oh, okay, great. On your Schedule D, report this as a capital gain." And she said, "I have to tell you though, this is the third time I sold my eggs." Now, for those who know about eggs, are you supposed to, as a woman, sell your eggs regularly? And the answer is no, because you don't want to get juiced up on Clomid regularly. It's not healthy. But a lot of people, to help pay for their education, would go from one infertility clinic to another. They don't keep records of what, for privacy, this is not information that's spread. So, if you sell your eggs on 3 or 4 occasions, all of a sudden, notwithstanding, it does have more of an aroma of being inventory, right? You sell it once, it doesn't. Eugene, you don't agree? Doesn't it look like a chicken of sorts, right? If you're selling your eggs on multiple occasions.
Well, I mean, you can't sell a fork on multiple occasions.
Wait, excuse me?
You can't sell like one of your forks on multiple occasions. That doesn't make it a trade good.
Well, it does start looking like once you sell it, but here you continually sell. Anyway, she
But,
was not my
let's say
great
you have,
test
like a yard
case.
sale every month. That's not like it's not like you're continually getting.
Listen,
Yeah.
if you want, and this was very disappointing. This became a test case. If you look up James Perez, Perez, in the tax court, this was an issue. This is a tax court case that came up years later. This case was decided about 2-3 years ago. And I was so excited because this was going to finally put this issue to bed. Okay, this is where I get my form of excitement. What happened though? I have to say this was poor lawyering, because what ends up happening is the taxpayer here, the woman who sold her eggs, took the position that it was not income, that the money she received was just a return of her basis. Like, she spent all this money feeding herself and keeping her body in shape, and that she was just getting a return on her investment, sort of like this was just reducing her basis in her capital stock. But I get that. I get it. I didn't think it was compelling. But her lawyer should have argued, in my opinion, that said, okay, if we don't win on this, just like you recall the first case you looked at, the piano case, they took different positions. Did not have a plan B to at least say, okay, if it is income, treat it as capital gains. This lawyer simply kept the argument as this was not income. So the court never decided whether or not it was capital gains. So notwithstanding this case is on the books saying it's income, and you guys were saying, of course it's income, Code Section 61, it never decided. So if you're selling your eggs, talk to me. We want to have our test case, okay? Or if you know a friend who's selling her eggs, let us know, okay? You're not going to be able to help us out here, James. Kyle?
So if a guy sells Or would that be a short-term capital gain?
No, because that's going to be inventory.
Right.
Kyle, the difference is,
No, you're
in
right.
my opinion, is, you're not born with it, you just create the stuff. Where women are born with it, and unlike inventory, it cannot be replenished.
Oh.
So I think men are never going to prevail on that issue. All right?
Have a little faith.
What was that, James?
Have a little faith.
No, no faith. Doesn't work. Not from the definition it's crafted. Okay? All right. All right. So anyway, guys, page 701, we're introduced to several cases. My point is, again, James, getting to your point, do we need a rate difference? There's so many cases decided, is it capital gains or ordinary income? If it were taxed at the same rate, all this would disappear. So again, raised rhetorically, is it worth having a different rate? We wouldn't be debating women's eggs or sperm or anything else if it were all taxed at the same rate. Agreed? But it is. Right now, guys, it's a religious doctrine. Just look at yourselves as a class. Everyone here said, oh, there should. So it's going to take a long time before people give up their religious beliefs. So for now, you got to really know this stuff. So Maudlin, go ahead. Sure, one.
No, but I don't feel it should be taxed though.
What?
I don't feel it should be taxed, Like,
What shouldn't be taxed?
Like a woman giving up her egg.
Why? Bring it up. She's selling it.
Selling it, but she has to go through so much suffering just to produce that egg, or
Well,
to even
Then
get
you
it out.
should. In your opinion, she should be paid for her labor. People go through Shervon, you want a tough job? Lay a hot tar roof on a hot summer day. Okay? Should they not be taxed because that's a lot of labor?
No, but the thing is, like, in your example, like, there's also risk involved of, laying down the hard tar on the roof. Same with the woman that's giving her eggs. I mean, her selling her eggs. There's risk involved with that.
I mean, you don't want to start getting into that because it's a very hard argument to make that this income is really hard to earn. Your income is easy. One shouldn't be taxed, one should.
The person who's buying the egg should be double taxed.
The person buying should be double taxed. I don't think you're being empathetic to the person who's suffering from infertility, who can't have a child of his or her own. Why should that person be double taxed? They're paying $50,000 some cases, or $5,000, whatever the case may be. If you ever find you have infertility, it is not for the weary at heart. It becomes a very hard and very expensive process. Before you say tax them double, a lot of trauma of their own, so be careful about that. Page 701, Maudlin v. Commissioner. Okay, here we have a case about a veterinarian, right, who buys some land, and when they buy the land, the veterinarian, they do it at least initially as an investment. Everyone agree? And if you buy an investment, what is it generally, capital or non-capital asset? Generally capital, right? Because when you think about our categories, you buy something as an investment, generally capital. But what happens? At first, guy can't get rid of this land, but then, because a road is put through, the land becomes much, much more valuable, and he starts subdividing, right, the land, and selling off different pieces, right? The question before the court is his inventory, would it give rise to ordinary income or capital gain? In other words, we know originally he went into it as an investment, but over time, what happens to that investment? Transformed, right, into inventory, right? Because he took that investment through his actions and making improvements to the property, it becomes inventory in his hands. So when you look at whether something is a capital asset, don't just look at the intent with which someone acquired the property. what happens to the property and when they sell it. Because the author's point in raising this case is that the character of property is fluid. It can change. Originally an investment, and then no longer an investment, right? Take away this case. I'm going to point out to you, if you want to open up, Kyle.
So using the same logic, let's say you're a dealer in like antiques or collectibles, because that's your main mean of income, selling these things, it's going to be taxed under your income tax or whatever.
Right? And your question is what?
No, I'm saying like that's the same logic that was used in this case.
Ultimately, that becomes the takeaway. If you want, though, Congress to help small business owners, and this is where the code becomes more complicated because Congress wants to be equitable and fair to small businesses. Look at Code Section 1237. Real property subdivided for sale. Look at Code Section 1237. It talks about real property being subdivided and held for sale. And in that case, in those instances, as long as it's fewer than 5 lots, okay, if it's fewer than 5 lots, Congress permits capital gain treatment. So if you're a small business owner and you don't make improvements to the property and you subdivide it, Congress gives a little license here that it does not become transformed into ordinary income. Code Section 1237. Go ahead, James.
I was asking authority.
Okay. Code Section 1237. Matt v. Riddle, page 705 is the U.S. Supreme Court case, but you're not getting the entirety of the case here, guys. You're not getting the entirety of the case. Just getting an issue where taxpayer would like to treat it as a capital gain. The IRS says, no, this is inventory. And if you look at the definition of 1221, Code Section 1221, A1, the last part of the clause, 1221A1, says, or property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. Property held by the, see the word primarily? Well, the Supreme Court is asked, what does the word primarily mean? I would like to read that primarily mean the word to mean significant. Supreme Court do? Pulls out the dictionary essentially and says, well, we think primarily doesn't just mean significant. Look at the bottom of page 706, it means of first importance or principally. Of first importance or principally. To do once it renders that, remands it to the lower court. Says, here's the standard you should be applying. You applied the wrong standard. The asterisk on the bottom of page 707. And the district court ruled that the real estate was not primarily for sale to customers in the ordinary course of the taxpayer's trade or business. So it reversed itself. And the note on page 707, section 1222 to apply, and I pointed this out last class. This is on the second full paragraph on page 707. It has to involve a capital asset. There has to be a sale or exchange. It has to be held for more than 1 year. Long-term treatment. 709, explore more, what is this sale or exchange requirement, right? We know a sale or exchange, seeing this in what code section? 1001, right? 1001 says computing gains and losses, right? Look at a sale or exchange. Code section 1222, and we have a second circuit opinion, Keenan. Keenan, even though it's not a Supreme Court case, is a well-recognized case. The proposition it stands for is very, in my opinion, very straightforward. You going to say something? Keenan owed a beneficiary $5 million. Owed a beneficiary $5 million. And just to simplify the facts, the estate has stock, let's say with a basis of $4 million, worth $5 million. So the estate is going to pay the beneficiary dollars with the stock that's appreciated in the hands of the estate. What do you think happens if you use appreciated property to satisfy an obligation? And we saw this in last class as well. And other cases make clear, anytime you use appreciated property to satisfy an obligation, it constitutes a sale or exchange, okay? It's the equivalent as if the taxpayer sold the stock for $5 million and then used the proceeds to satisfy the bequest. So Keenan, take away the Keenan case, again, is very straightforward. Is that if you pay off a debt with appreciated property, that's going to give rise to the taxable exchange. Nothing complicated in the Keenan case. We have the Hudson case. Now, you guys, when you take corporate tax, or if you, by the way, I was just going to give a little pitch here. Many people over the years, not the majority, but several people from the professional accounting class who I have not dissuaded from pursuing tax. You have a one credit corporate tax class after mine. Some people say, you know what? They want to pursue tax potentially as a career choice. And they end up taking during the summer my corporate tax course in lieu of, I believe, data analytics, something like that. So if you want to consider pursuing tax, you might consider taking a 3-credit corporate tax course. So if that's something that you might consider, you'll let me know. But I will say this, in corporate tax or partnership tax, which I'm teaching tonight, anytime, and even in this class, you'll see, I'm a big subscriber to stick diagrams for myself and for my clients. So that anytime you're reading a fact pattern that involves multiple parties, drawing a little stick diagram. And in this case, I have Mary, I believe that was her name, a judgment against Howard Cole, $75,000. Okay? $75,000 judgment. Excuse me. Against not Howard Cole, against I'm drawing a blank. Hudson. Howard Cole, $75,000. Then what ends up happening is that Mary dies. Okay? Mary dies, and Hudson pays $11,000, and in return gets the judgment. So picture below. Sadly, Mary dies, and Hudson buys this judgment for $11,000. He gets the judgment. To get a $75,000 judgment for $11,000, yeah, it's hard to collect. There's a lot of risk, right, Jung? And this guy is a deadbeat, right? And it may be very hard to collect. So he's taking a chance. Hudson's taking a chance that he may not collect a dollar. So he's paying $11,000. He'll pursue the case against Howard Cole. You recall how much he ultimately gets? Anyone remember? $1,000, but he's able to command $21,000, right? Obviously, he had, he maybe couldn't declare bankruptcy. He didn't, but he said, "Look, I won't declare bankruptcy. I'll give you something. I'm not going to pay you the full 75. I'll give you 21." Question in this encapsulated in this case is, how should report that $10,000 difference, right? The difference between $21,000 and the $11,000 that he paid, right? Ordinary income, right? Who prevails? Hudson's hands, he has a judgment, right? He purchased a judgment, but when he's paid the $21,000, true sale or exchange there, it's simply being extinguished. Everyone agree? There's simply a debt being extinguished, but he's not exchanging anything, right? Paid 21,000 on the judgment, but it's not like there's a true exchange. So the court said, look, we can't give you capital gain treatment. That's under Code Section 1222. There's not a true sale or exchange. Closes here. Now, remember, some of you have asked me, in Congress, if there's an outcome that Congress doesn't like, can Congress change the law? Yes. Take a look at Code Section 1271. Code Section 1271A. Amounts received by the holder on retirement of any debt instrument shall be considered as amounts received in exchange therefore. Here, let's apply amounts received by Hudson on the retirement of any debt instrument, right? He was owed 75,000 shall be considered as amounts received in exchange therefore. So Congress, vis-a-vis Code Section 1271, has rewritten the outcome of Hudson. So if you read the note that follows it, after 1997, Hudson would, under a similar fact pattern, command capital gain treatment. So for your notes, you may want to put after the Hudson case, see Code Section 1271, which reverses the outcome. Again, the authors are, one, giving us a definition of capital asset, and two, talking about the sale or exchange requirement. Next, we're going to get into the holding period. What is the holding period of your assets? Because we need to get to the promised land. How do we get to the promised land? Hold it for more than 1 year, right? We're ruling 66-7. Why is this in the case book? What is it referred to? Chance to read it? Young, you have a chance to read it? Didn't get there, Jack? It refers to holding property for more than 6 months. So why would it refer to holding property for more than 6 months? 66, I bet you. What do you think the holding period requirement was in 1966? Just point out that it was more than a half a year, but that's not why the authors who write textbook have it here, right? But they have it here for a different reason. When does the holding period begin when you acquire a property? When does the holding period begin? The day you acquire the property? The day before, the day after?
After you acquire it.
Okay? And if you look on page 718, look at the second paragraph. We're going, it is concluded the holding period of a capital asset begins to run the day following the date of acquisition of the asset involved. Everyone see that? So, James, you're right. It's the day after. Everyone have it? And that's what this revenue ruling, why it's important. It doesn't begin the day you acquired it, it begins the day after. There's a movie. Did you guys ever see, what's it called, Jordan?
The day after tomorrow.
The Day After Tomorrow, right? What's it about, Jordan? End of the world. How does the world end in that movie? Okay. Do you know, Jordan, did anyone else see it aside from Jordan? Okay. Many of you have seen it. There was one scene in that movie that I personally was extremely offended by. Do you guys remember what the most offensive scene? I comes to think, any movie I've ever seen, this is the most offensive. Jordan, what happens? Book did they burn? They said, let's start a fire. We're cold. Let's use the tax code. What's that movie? I warn you, you may have to cover your eyes now. It's a very scary scene. All right? So that's that revenue ruling. Then it's followed by revenue ruling 66-97. 66-97.
That's still a ruling, 66-7
Yeah, what do you mean?
in our big book.
I don't know what you mean by in our big book.
In this gigantic
But
tax book.
it's a revenue ruling. It's not a regulation. You're scaring me. I'll pretend I didn't hear that question. Okay? Revenue ruling 66-97. Okay? Revenue ruling 66-97 stands for a different proposition. What's important? Trade date or settlement date? What do you think? More important, trade date or settlement date? Example. trade date. Okay? Trade dates, not the settlement date. Okay? Is the operative date that's going to matter when we're computing holding periods. In the note that follows, multiple blocks of stock. First paragraph on page 720, language associated with footnote 3. That raises the basic question of identification, but if T is unable to identify which block was sold, regulations answer the question on a first in, first out basis. Everyone see that? 721, general, about some techniques taxpayers use to artificially potentially create long-term capital gain treatment techniques. The authors will describe as short against the box, and there's code sections that try to put the brakes on different strategies designed purposely to try to circumvent long-term versus short-term. And then on the bottom of page 721, the authors talk about options, okay? Options. And talk about gains and losses generally on closing an option going to be treated as short-term capital gains.
Option was held for a year.
If you let it lapse, you'll take a look at this. If you let it lapse, it's generally short-term. But if you sell it and you hold it for more than 1 year, it'll be long. So let me do this. I just want to spend some time because I have a suspicion that people have not read this far. So I want to catch up. Let me talk to you the next 5-10 minutes about some of the things, an overview, because next week, correct me if I'm wrong, next week is our final week before the exam, right? So let me give you some things that we're going to cover that I want you to look at. So beginning on page 723, there's some cases that give what the authors describe as color to the statute, right? Because the statutory language is not crystal clear, and cases embellish or augment the meaning of the statute. So beginning on page 723, we're going to get a better handle the meaning of capital assets and the like. Now, I will call to your attention, beginning on page 730, when it comes to measuring gains, something called, let me just give you by way of example, that if Jordan and Galena were married, okay, picture Jordan and Galena married. Jordan dies, sorry, Jordan. Jordan dies, he's worth $1 million. Not going to last too long, Galena, okay? Is that Jordan loves Galena, but he wants to make sure that if she moves in with husband number 2, that ultimately gets to their children of their first marriage, of their marriage. So Jordan, instead of leaving it outright to Galena, because he's worried about the pool boy, he's going to leave it in trust, okay? He's going to put that $1 million in trust. And when he dies, they have a son and daughter. The monies will be split between their son and daughter. Everyone have the visual? Has what's called a life estate. Everyone agree? In the money. She has a life estate. There are 2 children. What are they known as? They're beneficiaries, right? They're not, right now they have no interest. They don't have an interest until Galena dies, right? So they are what are known in my world as a remainder beneficiary. Start reading this material, and that's what I just described is a very, very common scenario for a whole lot of reasons. And us men typically go first, so it's fair for me that 80% of the time we go first. And in many instances, for a whole host of reasons, you may choose to leave it in trust, the surviving spouse, and on the demise of the surviving spouse, your children. So when you're reading, beginning on page 730, think of that as a paradigm of how to shape and formulate this. All right. Page 732 talks about the Watkins decision. We'll deal with it. That's a very easy case to read. And beginning on page 736, there is a discussion of correlation with prior transactions. What we'll see is that you treat things or have treated things in the past for tax purposes may color how you have to treat things in the future, right? So there is an indication that you have to be consistent. How you do something in the past may dictate how you have to report it in the future. Beginning on page 745, there's a bunch of different statutes that dictate how the code is going to treat certain capital, the disposition of certain capital assets or non-capital assets. So there's some special rules there. What I'm going to really call to your attention, and you really got to think about this, is beginning on page 750. Page 750, we're going to begin a discussion. 31 assets. As I said to you before, spend the next 5 minutes telling you about 1231 assets. Suppose you have 1231 assets. You bought a machinery for $50 to $100. You bought it for $50. It's now worth $100. Change it. You bought it for $60. I think it's easier to follow. You bought it for $60. It's now worth $100, and you sell your 1231 asset. Get capital gain treatment or not? You're shaking your head no, but the answer is yes, because, appreciate this, Wendy. That's supposed to be a happy face. 1231 is a pro-taxpayer position, particularly like this. Okay? 1231, take a look at it together. Have it open. If the gains exceed the losses, if the section 1231 gains for any taxable year exceed the 1231 losses, such gains and losses shall be treated as capital gains or long-term capital losses, as the case may be. So if the gains, okay, let me repeat this. And those on WebEx, you can't see me, but I'm holding up my right hand and my left hand is down. Exceed the losses, everything's capital. I bought it for 60. Bought it for 60 is my just basis, and I sell it for 20,000 loss. Isn't that dandy? That if the gains exceed the losses for the year, you get capital. But here, if the losses exceed the gains, you're not subject to the code section 1211 limitations. So in part A2, it says gains do not exceed losses. Section 1231 gains for any taxable year do not exceed the section 1231 losses. Such gains and losses shall not be treated as gains or losses in a sale or exchange of capital assets. Translate, that means you get ordinary loss treatment, right? Ordinary loss. Now,
Not apply to that.
inventory is not a 1231 asset. But suppose we have two sales. We sell two 1231 assets. We sell two 1231 assets. Gain of 30. And on the second asset, we have a loss of 10. What is the character of the gain and the loss? Loss of 10. What's the character? Capital or ordinary. Exceed the losses, everything is capital. This would be capital gain. This would be capital loss, right? Once you say the gains exceed the losses, it's all capital. Agreed? If there is a 30,000 loss, there's a 30,000 loss, and there is a 10,000 gain on a different asset, right? You sold two cash registers, one for 30,000 loss, one for $10,000 gain. What's the character, guys, of these? This would be an ordinary loss, ordinary income. So you have to decide, do the gains exceed the losses or the losses exceed the gains? Because the tax consequences are going to be wholly different. So let me ask you, what is the key? And this goes to your interpersonal relationships. Who's married here? I forget from last. Lena and Wendy. With your spouse, what is one of the most fundamental characteristics that you must exhibit during your marriage? And you can apply it in the 1231 context to make a successful relationship. let the class know and let them know with 1231. What is that key ingredient that's going to make you and make your marriage last till your 70th anniversary? The glue, what do you need to exhibit? What was that? What's some of the glue? Give me some adjectives, the things that keep your relationship strong. Compromise. Children is something, so that's not a characteristic, that's procreation, but I don't know if that applies to 1231. As a significant other, and identify what I'm driving at. That's true, but you need, that's a cliche, you need things to fill that in.
What?
I'm going to give you it. Obviously, you got to work at the relationship. You got to show empathy and all sorts of other things. But in the 1231 context, you, Jim, what you have to do is be patient, right, Galena, with your significant other, as they exhibit patience. And what do I mean, patience in the 1231 context? Because I know many of you, both in work and in class and on exams, what are you going to want to do when you hear that there's a gain? You're going to want to say, James, you want to deliver. You're going to say capital gain because it feels good to say capital gain. But if you ain't patient, and I see this routinely on exams, and I see it with practitioners, you got to wait until the end of the year because you got to see if the gains exceed the losses or the losses exceed the gains. You cannot jump to conclusions, right, Galena? Patient, right? Because you don't know if the gains exceed the losses or the losses exceed the gains. Do not jump to conclusions.
Isn't that kind of given though? Don't you file your taxes after the fiscal year?
See someone raise that in practice, they're saying, oh, I'm going to sell this asset this year.
So
You're
I
not,
could get a gain.
you're not just preparing returns. You're going to say, someone's going to say to you, oh, I plan to sell this in February. What kind of treatment? And you're going to say, oh, it's a 1231 asset, capital. In your advice, it may not be a capital gain because they may have other losses that transform that into an ordinary income. My point is, James, you're not just preparing tax returns if you're really good at this stuff. People are going to ask you your advice.
I see what you're saying.
All right? So